Jake picks 12 stocks. He spent 3 weekends researching them. Marcus buys one index fund. He spent about 11 minutes setting it up. They both invest for 20 years. They both think they made the smart choice. They're both partially right. But one of them is going to retire with significantly more money, and it's probably not the one you're rooting for right now. Let's keep this fair. Jake and Marcus are both 30. Both earn $70,000 a year. Same city, same brokerage account, same $500 a month to invest. The only difference is what they buy with it. Jake builds a portfolio, 12 stocks carefully chosen, 2 tech giants, 1 healthcare play, a bank he actually uses, 2 consumer brands he believes in, an energy company, a defense contractor, a retail chain, 1 speculative biotech he's excited about, a real estate investment trust, and 1 international company because he read that diversification matters. He spent real time on this. Earnings reports, price-to-earnings ratios, Reddit threads, YouTube breakdowns. He has a spreadsheet. He has a thesis for every single position. He is not guessing. He is investing. Marcus opens a brokerage account, types in the ticker for a total stock market index fund, sets up a $500 automatic monthly contribution, and closes the app. He does not have a spreadsheet. He does not have a thesis. He has a confirmation email and a vague sense that this is probably fine. Jake's coworkers ask him what he's buying. He tells them. They're impressed. Marcus tells people he owns an index fund. They nod. Nobody asks a follow-up question. On every social scoreboard, Jake looks like the serious investor. Marcus looks like someone who gave up before he started. But feelings and math are 2 very different things. For the first 2 years, Jake looks like a genius. His biotech position is up 40%. His tech holdings are riding a strong market. His portfolio is up roughly 18% in year 1 against an index return of about 14%. He's beating the market. He has the screenshots to prove it. He sends Marcus a text. Marcus responds with a thumbs-up emoji. Jake's $6,000 in year 1 contributions has grown to about $7,800. Marcus, with the same contributions, is sitting at about $7,400. The gap is $400, and Jake is very aware of it. By year 2, Jake's portfolio is up another 11%. The index is up about 13%. He's slightly behind now, but his biotech position just got a positive FDA mention, and he's not selling. He's holding. This is a long-term play. Marcus hasn't looked at his account in 4 months. Here's what's actually happening underneath the surface in those first 2 years. And it's the thing most people never measure. Jake made 23 trades in year 1. Some were additions, some were trims. One was a full exit from a position he lost conviction in after a bad earnings report. Each trade had a cost, not just the commission, which some brokerages have eliminated, but the spread, the timing, and in taxable accounts, the tax event. Every time Jake sells a winning position, even partially, he owes capital gains tax. Short-term gains, anything held under a year, are taxed as ordinary income. At his bracket, that's 22%. Long-term gains get a better rate, but Jake is actively managing. He's rotating. He's responding to news. Marcus has made 0 trades, 0 tax events. Every dollar of growth is compounding untouched. This is the first hidden cost nobody puts in the headline. Activity has a price, and it's not always visible on your statement. By year 5, something quieter is happening. Jake's portfolio is up overall. He's a solid investor. But here's what his 5 years actually looked like, position by position. His 2 tech giants are up significantly. They carried him. His healthcare play is roughly flat after a rough 2 years. His bank stock dropped 28% during a regional banking scare and recovered about half of it. His energy company surged when oil prices spiked, then gave most of it back. His biotech, the one he was most excited about, failed a phase 3 clinical trial in year 3, down 74%. He held it because he believed in the science. That position is now worth less than a quarter of what he put in. His retail chain filed for bankruptcy protection. That position is worth approximately nothing. 2 winners, several middlers. 2 meaningful losers, 1 catastrophic loss. The math on Jake's portfolio, after 5 years of $500 monthly contributions, roughly $41,000 invested, his balance sits at approximately $48,000, a gain of about $7,000, or a return of roughly 17% on his contributions over 5 years. Not bad. Until you run Marcus's numbers. Marcus, same $41,000 invested, same 5 years. His index fund return at roughly 10% average annual growth. His balance is approximately $52,000. A gain of about $11,000. Marcus is ahead by $4,000. Jake stares at this for a while. Then he decides his problem was the biotech and the retail pick. Bad calls. The rest of his portfolio is solid. He rebuilds. He trims the underperformers and concentrates more in his winners. He adds 2 new positions he's researched carefully. He is not giving up. He is improving. This is the second hidden cost. The psychological cost of managing individual stocks warps your judgment in ways that are almost impossible to see in real time. When you own 12 stocks, you have 12 relationships, 12 companies whose earnings calls you follow, 12 sets of news alerts, 12 moments per quarter where you have to decide, do I hold, do I add, do I sell? And each of those decisions carries the weight of your identity as an investor. Jake doesn't just own a ticker, he has a thesis. And when the thesis gets challenged, he defends it. Not always because the data supports it, but because changing your mind feels like admitting you were wrong. Behavioral economists have a name for this. It's called thesis lock. And it's why retail investors systematically hold losers too long and sell winners too early. Marcus has no thesis to defend. He owns the market. When part of the market goes down, another part goes up. He doesn't have to make a call. He doesn't have to be right. He just has to stay. By year 10, the compounding math starts to separate them more clearly. Jake's portfolio, now refined after lessons learned, sits at approximately $118,000. He's a better investor than he was at 30. His winners are real. His process is sharper. He's up meaningfully. Marcus's index fund sits at approximately $134,000. Jake is behind by $16,000. He's been doing this for a decade. He has spent hundreds of hours on research or earnings calls, portfolio reviews. Marcus has spent approximately 4 hours total across 10 years glancing at his balance. Here's the part that makes Jake's stomach drop when he actually runs the comparison. It's not just the dollar gap. It's what created it. Jake's 12-stock portfolio has 3 positions that significantly outperformed the index. 3. Out of the 15 total positions he's held over 10 years, 3 were exceptional. 4 were roughly market matching. 5 underperformed. 3 were meaningful losses. 1 was a near total loss. This is not unusual. This is not a sign that Jake is a bad investor. This is just what stock picking looks like when you run the actual distribution. Research from multiple decades of market data points to the same pattern. The majority of individual stocks underperform the market over any given 10-year period. The market's strong returns are driven by a small concentration of massive winners, and those winners are not predictable in advance. Amazon looked like a risky bet in 2001. Apple looked overvalued in 2013. Nvidia looked like a niche chip company until very recently. The investors who caught these weren't necessarily smarter. They were often lucky and then smart enough to hold. When you own an index fund, you own all of them. Every future Amazon, every future Nvidia. You can't pick them in advance, but you don't have to. The index holds them automatically and weights them by their success. When Jake picks 12 stocks, he's betting he can identify the future winners in advance and avoid the losers. He's playing a game where the professionals with armies of analysts, proprietary data, and algorithmic trading systems are his competition, and the data on how that game usually ends for individual investors is not encouraging. Let's talk about concentration risk, because it's the one Jake feels most personally. By year 10, 2 of Jake's 12 positions make up 44% of his total portfolio. They've been his best performers, so he's let them run. He hasn't trimmed because trimming means paying taxes on the gains, and he believes in these companies. This is the third hidden cost. Concentration looks like conviction. It feels like confidence. But it is also a single point of failure with a large percentage of your retirement sitting on it. Marcus's index fund holds over 3,500 companies. The largest single position in a total market fund is less than 5% of the total fund. No single company can collapse his retirement. A sector can struggle for years, and his overall portfolio will absorb it. Jake is not unaware of this. He's thought about it. He tells himself that concentration in winners is how real wealth is built, and he's right that this is how some wealth is built. It's also how a lot of wealth is destroyed. The investors who got rich through concentration are the ones who talk. The investors who lost significantly through concentration are not at the barbecue explaining their strategy. Now let's address the part I'd be leaving out if I only told you Marcus's side of this story. Index funds have real limitations, serious ones, and anyone who tells you otherwise is doing what I accuse Jake's coworkers of doing, being impressed without running the numbers. When you buy a total market index fund, you buy everything, the good and the terrible, the companies with strong fundamentals and the companies with none. The index does not distinguish. It holds them all, weighted by market capitalization. When a company's stock price goes up, the index buys more of it automatically, regardless of whether the valuation makes sense. You are not buying companies. You are buying a weighted reflection of what the market currently believes about companies. In periods of extreme speculation, this can work against you. Index funds were heavily concentrated in technology stocks at the peak of the dot-com bubble. They held more of the most overvalued companies right at the moment when valuation mattered most. An active investor who saw this and stepped aside would have fared better. In 2000, they existed. They were rare, but they existed. There's also no ability to tilt toward value. A sophisticated investor can construct a portfolio that overweights undervalued companies, or profitable small caps, or dividend-paying stocks with strong balance sheets. Academic research suggests certain factor tilts do outperform the market over long periods. An index fund gives you none of that nuance. You get the whole market, full stop. And there's the psychological reality Marcus hasn't been tested on yet. He's never watched his portfolio drop 35% in 6 weeks and had to not sell. A total market index fund dropped over 50% during the 2008 to 2009 financial crisis. It recovered, eventually. But Marcus was watching a number on a screen go from $130,000 to $60,000, while every news channel told him this time was different. The investors who stayed are the ones who built wealth. Most retail investors did not stay. They sold somewhere near the bottom and bought back in somewhere near the recovery, locking in losses, missing the return. Jake's response to crashes is complicated, but it has one advantage. He knows his companies. He's read the earnings reports. He has a reason to believe in the positions. That conviction, even when it causes thesis lock, can also prevent panic selling in ways that blind index ownership sometimes cannot. By year 20, this is where they land. Jake's portfolio, 20 years of $500 monthly contributions, active management, lessons learned, setbacks absorbed. His balance sits at approximately $310,000 to $340,000. His annualized return, accounting for the real history of his decisions, lands around 7.5 to 8.5%. Good. Genuinely good. Better than most retail investors manage over 20 years. Marcus's index fund at roughly 10% average annual return, 20 years of $500 monthly contributions without a single stock pick. His balance sits at approximately $380,000 to $410,000. The gap is somewhere between $60,000 and $80,000. Marcus has more money. He spent fewer than 10 hours managing it. He did not beat the market. He was the market, and the market was enough. But here's what the gap doesn't capture. Jake is a genuinely better financial thinker than he was at 30. He understands earnings, valuations, sector dynamics, macro conditions. He reads balance sheets. He has perspective and context that Marcus simply doesn't have. That knowledge has value beyond his portfolio. It changes how he thinks about his career, his business decisions, his compensation negotiation. You cannot reduce a 20-year education in market dynamics to a dollar figure and call it a fair comparison. Marcus has something different. He has time. 20 years of not thinking about his portfolio is 20 years of mental energy that went somewhere else. That's worth something too. But it's worth something different. So what actually works? The answer most certified financial planners give when someone asks this question directly is, it depends less on which you choose and more on what you can actually stay with through a crash, a career change, 2 recessions, and a global pandemic. The data on index fund outperformance over stock picking is robust and consistent. Over 10 years, roughly 85 to 90% of actively managed funds underperform their benchmark index. Individual stock pickers fare worse on average, not better. This is not controversial in finance. It is simply inconvenient for people who enjoy the process of picking stocks. If you are picking stocks because you genuinely enjoy it, treat it like that. Keep the majority of your portfolio in an index. Use a smaller allocation, call it 10 to 20%, to pursue individual positions where you have a real thesis and real conviction. You get the intellectual engagement. You limit the downside of concentration risk. You stop betting your retirement on your ability to predict the future better than the market. If you are picking stocks because you think it will make you significantly richer than an index fund. The evidence says otherwise. Not always. Not for everyone. But for most people, most of the time, over most 20-year periods. The real mistake isn't choosing the wrong account or the wrong strategy. The real mistake is spending 20 years playing a game whose rules were quietly stacked against you without ever stopping to check the scoreboard honestly. Jake's 12 stocks weren't a failure. They were an education. But education at the cost of $60,000 to $80,000 in foregone returns is an expensive classroom. The index doesn't require you to be right. It just requires you to stay. And staying, as it turns out, is the hardest and most profitable thing you can do.